Hello and welcome to a brand new show of Market Makers. My guest on the show is someone who truly believes that in any financial market, growth and value, they truly coexist. Price is what you pay, value is what you get. So my guest on the show today is Rajeev Thakkar, CIO with PPFAS AMC. It's your first time on ET Now and first time on Market Makers, so a very warm welcome and thank you for joining us.
Thank you for having me. Pleasure being here.
I'm going to start with the very basic market view. Even though you hate to talk about markets because you believe in not benchmarking against an index, but what is your view on the market stroke economy right now?
So we are in very interesting times. We are at levels which traditionally would be above average valuation kind of scenario, whether you look at price to earnings, trailing price to earnings, or market cap to GDP, etc. Not only in India, even globally. But at the same time, we live in a world where capital is very cheap, money is sloshing around. So we have record low interest rates, and these are not very short-term aberrations. We have 10-year Swiss bonds at negative yields, 7-year German bonds, negative yields. So really, if you are an endowment or a pension fund, opportunity set is limited. And even at these levels, if liquidity were to prevail and if money were to slosh around at such low levels, I think valuations may be sustained. So we are in a low inflation, low growth world. So nominal return expectations have to be toned down. One can't expect 20% kind of returns. Maybe one should be happy with a 10 to 15% kind of returns, but which is not bad when inflation is under control.
Now everything has gone our way in last 12 months. Oil prices have come down, interest rates have come down, China has been in a disarray, there are problems and there are simmering problems in the European zone. So India currently is the port of call for global investors. Yet in this year, markets are down, foreigners are selling. Shouldn't it be the other way around?
Well, we can always ascribe reasons as to why something happened after the event. So it's a surprise that foreign investors have pulled out money. But I guess part of the reason would be that post-general elections, there was this euphoria, a lot of money came in with a certain set of unreasonable expectations in the short term, which would have got corrected. I think fundamentally things are moving in the right direction. Be it the commodity cycle being huge energy importers, it's good for India, good for inflation, and so on. Even we have a situation where now states are competing with each other to improve their ease of doing business rankings and so on. So, which is good for the country. I'm positive on the way things are moving. As to why money got pulled out.
That's a debatable question right now. But the way you invest and the way you pick up stocks is that you never look at the macro. You always look at individual companies, individual businesses, buy good companies at a reasonable price, and then then ride them for at least 5 to 10 years.
That's correct.
The mantra which has worked in 2015 so far is buy quality at any price. Right now, good companies are trading at insane P multiples. Good quality companies which have great capital allocation is your hunting ground also. So is it a difficult environment for a mutual fund manager to invest?
Oh, absolutely. And for people who are talking about this consumption theme and great quality businesses, great capital allocation, and so on and so forth, I have to go back and say, look at what Buffett has said. He's never said the most important word in investing is moat, or the most important words in investing are capital allocation. He has said the most important words in investing are margin of safety. So I think at current valuations, there's absolute lack of margin of safety and things are priced to perfection or even above that. So especially in the Indian context, it's difficult finding great businesses at attractive valuations. What has helped us is the flexibility to go overseas. So we have been playing some valuation arbitrages where Indian arms of multinationals are trading at maybe 3 times, 4 times the valuation of the
That is the
parent.
standout feature of your scheme. The standout feature of your scheme is that nearly 1/4 of the portfolio is invested in global companies. Your largest holding is Google. You got a Nestle in between, and then you got a 3M global as well. So let's start with your number one holding, Google. What makes you interested in buying into Google? For a fund of your size, you're betting on a company which is one of the biggest company in the world.
True. So a big trend is underway globally where media is consumed on demand, and it's not the newspaper that gets delivered to your home or the television channel which is live, but television channel which is either recorded on a DVR or which is streamed on the internet. So very recently, I think Wall Street Journal had this article where the younger audiences have seen a dip of around 33% in television viewership. So in this world,
somehow I don't remember these articles which talk about dip in television viewership. That's not good for my business.
Sure. So actually, it's not that media is not being consumed.
Yes, it's been consumed differently.
The television content would still be consumed, but it would not be consumed when you broadcast it. It may get recorded or it may be streamed over the internet. The mechanism has changed. It's not that people have stopped watching movies. HBO, which was seen live, is now probably streamed on an app or is recorded on a device. So that has changed significantly. So what this does is the different form of media consumption. What this does is that it opens up opportunities for targeted advertising. So this targeted advertising has been growing at a fast clip today. Google's ad revenues surpass all the US newspapers put together. And this hasn't happened overnight, it's happened over a decade, and that trend is continuing. Again, as we speak, another big shift is happening, which is the move away from desktop and the computing devices to the mobile devices. And mobile devices get only 7% of the ad revenue, and the time spent on those devices are maybe in excess of 25%.
From how many years you've been owning Google in your fund?
So our fund is 2.5 years old. We have been holding in the fund. Earlier, for our advisory clients also, we have been owning this. So we have been owning this since 2010.
And you have plans to stick to Google for another next 5, 7, 10 years?
We may, yes.
Because you think the growth for the company is going to be sizable.
So it's amazing. It's Google at number one, and then the also rans. So whether we look at the search engine, whether we look at the Android operating system, whether we look at maps, whether we look at mail, translate app.
So they've got an ecosystem in place. Okay, yes. If I move to a second holding, the market capitalization drops. Market capitalization drops dramatically from about $400 billion to just 1,600 crore. Yes. Maharashtra Scooters, yes. Unknown company, they don't have a great brand. I don't know whether they have a competitive edge or not, because frankly they've struggled to compete against the TVS and the Hero Motors of the world. Why do you like Maharashtra Scooters?
So Maharashtra Scooters actually is a play on the Bajaj group.
Okay.
And in the marketplace there are many investment companies, but a lot of the underlying shares we would not like. So here Maharashtra Scooters is a play on Bajaj Auto, Bajaj Finserv, and Bajaj Holdings. As a business group, broadly we like the group, so we like the passion of Rajeev Bajaj in terms of the two-wheeler
execution, yes,
play and execution over there. What Sanjeev Bajaj is doing in the financial services play is good. So we have been buying Maharashtra Scooters, or we have bought it when the stock price was at maybe 20% of the underlying investments. Of course, prices moved up now. So
what is the value of the underlying investment according to you?
So underlying investments would be north of 4,000 rupees a share.
And they keep on increasing because every day Bajaj Finance price and Bajaj Auto price are moving up. So the underlying value also moves up.
True. As the underlying companies do well, the intrinsic value also moves up.
Do you think your fund has a huge advantage purely because of the size? Most of the other large cap funds may not think of buying a company which has a market capitalization of 1600 crore. So is that the uniqueness which you bring on the table right now? You can go global and you can buy Indian micro caps.
It gives a lot of flexibility, that's true. As size increases, the flexibility to go in for lesser market cap stocks goes down to that extent. And even if they were to invest in such companies, it would not make a meaningful position of meaningful percentage of the overall portfolio.
If I scan through your other holdings also, there are stocks where the P multiples are north of 25. There are stocks where P multiple are south of 10. So obviously you don't look at P multiple as the only benchmark for buying a stock. I mean, stock does not have to be cheap just for you to buy it.
So
a case in point here is HDFC Bank, I mean, which is not a cheap stock, but yet you own it.
True. So P multiple is a rough metric to judge how much a stock is relative to its current earnings. It doesn't tell you anything about what will happen in the future. So a stock which is 2 times trailing earnings and which is going to go bankrupt the next year will be expensive, whereas something which is loss making today but which is going to make a huge amount of profit next year could be cheap. So especially in the banking space, again to quote Buffett, he said that in the banking space where leverage is 10-20 times the underlying net worth of shareholders, the smallest mistakes in terms of lending or in terms of managing the balance sheet can be catastrophic for shareholders. He says, whenever I go for banking businesses, I am not interested in buying the cheapest banks. I am interested in buying the best quality banks. And in the banks, typically people look at price to book more than price to earnings. So you named HDFC Bank, let's say 4x price to book or thereabouts. What is the book value is again a question. So in some cases, price to book may be less than 1. But if that book value itself is suspect because provisioning has not been adequate and so on. So in the banking space, we see it as one of the last sectors with strong licensing entry barriers, 70% market share still with the public sector guys, overall economy growing, nominal money supply growing at maybe 13-14% plus market share gains. So there's a long runway ahead of these banks. Essentially what you want to do is you want to buy banks which will not get into trouble over the next 10 years.
Because banking is about trust, and you can trust the services and trust the book and the services from HDFC Bank. So can HDFC Bank be part of a long haul portfolio? When I say long haul portfolio, I'm looking at not years but decades.
It can be, yeah. It has
you
potential.
don't worry about the disruption, small bank, technology, payment bank. The way we are banking today will change the way we will bank tomorrow and the way our children would be banking. So the advantage of reach, branch, that may not exist. And the smaller banks, of course, will be able to adapt it in a much cheaper manner. That's disruption which is staring on your face.
So if you look at, let's say, last 400 years, or since the dawn of civilization, maybe people needed some kind of banking services. Earlier, it could be a rich family in the village where people would trust their money and so on. But the basic function of giving your deposit or borrowing money, a store of value or a safekeeping place, that function has not changed over the years. We have had many changes coming in, introduction of check clearances, electronic banking, ATM networks, and so on. I think the mobile wallets and payment banks and devices and all that is another change. The basic functions will not change. Also, some of these disruptions that are happening are in the space of making payments more convenient rather than changing the basic nature of deposit taking and lending.
So PSU banks will suffer more. Good private banks actually will be able to gain more market share because they have technology and talent to adapt.
Actually, I have a slightly different take on this. The payment banks actually will address, or the payment wallets, both of them, I'm using it somewhat interchangeably, they will address a market which is not in the formal sector right now. So if you look at the biggest case of Paytm, for example, the mobile wallet, it is actually making electronic payments for a cab service where cash was paid earlier.
Of course.
It's not replaced my check writing so far.
It's the unorganized player who's now reaching the organized player. That's a brilliant point. So I'm going to move away and talk about one of your another interesting holdings, where clearly the organized sector is consuming more, and that is Zydus Wellness. It is a market leader in the sugar-free market, which is a great market for them. But the non-sugar ventures are hurting them now, whether it is diversification in health or beauty. So first, why do you like Zydus Wellness? And then I'll give you time to defend then non-sugar business.
Sure. So people say India is the diabetic capital of the world, and the unfortunate part is once you get diagnosed with diabetes and sugar goes into the restricted category, people who have a sweet tooth look for alternatives.
I have one, a big one actually. I don't know about you, but
I'm in that space. So people look for alternatives. Now, whether it's a natural alternative in terms of stevia leaves or aspartame or sucralose. So Zydus is present in all three spaces depending on the preferences of the consumer. So the artificial sweetener or the natural sweetener, alternative sweetener space looks good. They clearly are the market leaders and early movers in that space, have good distribution reach. I think that has potential of growing well over the years. They've been struggling in the face pack and those kind of categories. I think over a period of time that will be a smaller portion of their overall business.
But the main business is growing.
Business
What about
is-
margin of safety? You dwelt on that aspect, margin of safety. When you buy a stock, look at the downside first before you chase the upside.
True.
Zydus Wellness is not cheap, at least by traditional parameters, at least according to me.
So if you look at the consumption space, I think it's one of the cheapest stocks around. So if you look at the typical fancied undergarment companies or paint companies or those kind of things where
On a
earnings
relative
multiples
basis,
are-
what about absolute?
Absolute also, I think somewhere about 30 times earnings, where it's a market leader where the base is extremely small. So today you have a huge population which is undiagnosed. The people may have a diabetes condition, but they don't know. The moment a needle is stuck in their arms, they become consumers of the company.
And then automatically you switch from cane sugar to sugar free.
Yes.
That's the turning point according to
That's
you.
the turning point. So we have seen this in a lot of small companies or companies with a small base in the consumption space. So whether it's agrotech foods or whether at one point in time Tanishq, which was just coming into the organized jewelry space and so on, the earnings multiple will look very steep because the base is so small. So on a small base, growing sales, growing profits is not that difficult.
Because you're always buying future earnings, and present earnings may look strong when you're buying future earnings. Of course, projections, they will change. Mahindra Holiday, it's been part of your portfolio. It's from a great corporate, market leader. I think they are more than 80% market share right now. But what I worry about Mahindra Holiday is that the membership numbers have been slightly volatile.
So more than membership numbers, I have other worries. So it's not that the company has been blemish free or the company has had everything going for it. More than membership numbers, our concern historically was to a certain extent dissatisfied members.
Okay.
I'm talking about 3 years back.
Okay.
So what had happened is that they were very aggressive on the selling side. A lot of schemes where they get free TV and so on and so forth. People took up membership and then did not follow through with installment payments and so on. And people who were regular members, who were paying installments and all, because sales were done very aggressively and build-up of resorts was lagging behind, they were dissatisfied because they would not get.
But is that
their
getting
holiday.
sorted?
That has got substantially sorted in the last 2 to 3 years. They are on track now. The legacy membership has been going out off books.
Yeah.
So the reason why growth has not been there to a large extent is because when they have been signing up new members, some of the older sign-ups have been cancelling memberships by not paying installments. So I think that is coming to an end.
But again, this could be a long haul stock for you.
It could be. There are some concerns which we are monitoring. It's finally in terms of how they execute the whole piece. But otherwise, we love the business model in terms of getting money from the client upfront, almost guaranteed occupancy rates because people have pre-signed up, not much capital requirement because it's self-funded and so on.
For someone who's watching the show, your message would be that if you have a 1 year time frame, don't come to me. If you have a 3 year time frame, I could consider you. But you should invest with your mutual fund scheme if you have a minimum time frame of at least 5 years.
Yes, I would say that. It's not, equity is not a product for generating regular income. It's a product for growing capital or protecting purchasing power over the long period. And 1 year time frame, some people who would have generally come to the equity markets 1 year back would be right now thinking, what did we do? Because headline indices have gone nowhere but down over the last 1 year. So it's not a place where you come for 1 year or 2 years. And in fact, especially given the fact that we are not closely hugging the stocks which are part of the benchmark and we construct the portfolio on a bottom-up basis, our performance may be dramatically different, plus or minus, as compared to the benchmark.
Yeah, so it's an absolute return portfolio. Don't compare your fund's performance with a Sensex benchmark and don't compare it with other schemes. Final question, your fund has given a CAGR return of more than 20%. More than 20% in last 2.5 years, tax-free. How come it's got unnoticed? You don't like to talk about your scheme, no, large distributors, no marketing professionals. Why is that?
So, in the investment management space, we were earlier operating under the portfolio management license. Okay. We are relatively new to the mutual fund space. We have been here 2.5 years. Our plan at the time of launch itself was that the first 2 to 3 years we'll spend in terms of building that.
So let the action speak, not the words.
Yes. So, a lot of agencies which track mutual funds, so be it Value Research or CRISIL or Morningstar, or most people have a criteria that we will start rating funds after a 3-year track record and so on. So initial period we would rather build
performance than the world talk. Okay, final question, 30 seconds. Summarize your investment philosophy. Great investors, they say that they can summarize the investment philosophy in one line.
Okay, it's buying a business, not a stock. It's buying a business which is attractive at reasonable valuations and stay with the business for long, let it compound.
My final line would be, price is what you pay, value is what you get. That is what equity investing is all about. Good luck for the year 2016. Pleasure to have you on the show.
Pleasure.
That's it on this edition of Market Makers. Thank you for tuning in and thank you for watching the show.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.